Imagine this. The world's most powerful financial system freezes. ATMs still glow. Markets are still open. Numbers still move on screens. But underneath, nothing works. Money stops flowing. Trust disappears. And the only thing standing between order and chaos is an emergency button no one likes to talk about. That button is intervention. And without it, modern finance doesn't survive. Not for long. This matters right now because we are living inside a system that publicly celebrates free markets, while privately depending on constant rescue tools to stay upright. Tools that were supposed to be temporary. Tools that quietly became permanent. Tools that almost no one understands, but everyone relies on. The uncomfortable truth is this. Modern financial systems are not self-correcting machines. They are stress-sensitive organisms. And when stress spikes, they don't heal themselves. They get life support. Let's rewind. In theory, markets are supposed to work like nature. Weak companies fail. Strong ones survive. Prices adjust. Capital flows to its best use. Clean. Efficient. Almost poetic. In practice, that world lasted about 5 minutes. Because finance doesn't just move money. It moves expectations. And expectations can collapse faster than balance sheets. Picture a bank. A simple one. It takes deposits. It lends them out. It earns the spread. But here's the first crack in the story. That bank does not have your money. Not all of it. Not most of it. Sometimes, not even close. It works because not everyone asks for their money back at once. Confidence is the asset. Trust is the collateral. Now zoom out. Banks lend to businesses. Businesses rely on payroll. Payroll feeds consumption. Consumption keeps prices stable. Prices stabilize debt. Everything depends on everything else. It's elegant. And incredibly fragile. Because when fear enters the system, math stops mattering. People don't ask, "Is my bank solvent?" They ask, "Can I get my money today?" That single question has collapsed more institutions than bad loans ever did. This is why intervention tools exist. Not because policymakers love control, but because panic spreads faster than policy. The first major realization came during the Great Depression. Markets didn't self-correct. They spiraled. Banks failed. Credit vanished. Deflation fed fear. Fear fed more deflation. So governments stepped in. They guaranteed deposits. They stabilized prices. They became buyers of last resort. The uncomfortable lesson was learned. Left alone, financial systems don't gently reset. They cascade. Fast forward. Decades later, new safeguards are built. Regulations. Capital requirements. Stress tests. Risk models. Everyone feels smarter. Then 2008 happens. The system wasn't taken down by obvious fraud or reckless gamblers. It was taken down by safe math. Mortgage-backed securities. AAA ratings. Diversification models. All perfectly logical. Until they weren't. Housing prices dipped. Confidence cracked. Liquidity vanished. Banks stopped trusting each other overnight. And suddenly, the global economy was 3 days away from payroll failure. Not recession. Failure. That's when intervention tools stopped being theoretical. Central banks opened unlimited lending facilities. Governments backstopped entire industries. Trillions were created with keystrokes. And the system survived. Barely. This is where the story gets awkward. Because once you save the system this way, you can't pretend you won't do it again. Markets remember. Risk models adapt. Behavior changes. This is called moral hazard. But that phrase hides something deeper. The system becomes calibrated to intervention. Interest rates stay lower for longer. Debt grows larger. Balance sheets stretch thinner. Why? Because the cost of collapse is now unthinkable. Intervention isn't just a tool anymore. It's an assumption. Let's simplify how these tools actually work. Central banks control the price of money. Interest rates. Liquidity. Confidence. When markets freeze, central banks inject cash so institutions don't collapse simply because everyone panicked at once. They act as lenders of last resort. Not to save bad decisions, but to stop contagious fear from destroying functioning systems. Then there's fiscal intervention. Governments step in when demand collapses. Stimulus checks. Infrastructure spending. Emergency programs. Not because it's elegant, but because unemployed populations don't wait patiently for long-term equilibrium. These tools stabilize time. They buy breathing room. But here's the hidden math. Every intervention pulls demand forward. Every rescue shifts risk into the future. Every stabilization creates dependency. Debt doesn't disappear. It migrates. From households to corporations. From corporations to governments. From governments to central banks. The system looks stable. But it's heavier. Slower. More sensitive to shocks. This is where hype and reality split. The hype says intervention prevents crashes. The reality is intervention changes the shape of crashes. Instead of frequent small failures, you get rare but massive ones. Instead of visible volatility, you get hidden pressure. Instead of correction, you get compression. Like a fault line that hasn't moved in decades. Quiet. Stable. Loaded. There's irony here. The more successful intervention becomes, the more necessary it gets. Markets price and rescue. Investors chase yield. Risk concentrates. And eventually, the intervention itself becomes the risk. We saw a glimpse of this during the pandemic. Entire economies were shut down. And instead of collapse, markets soared. Because intervention was faster than fear. Trillions deployed. Rates cut to zero. Assets inflated. It worked. Until inflation arrived. Then the tools reversed. Rates rose. Liquidity tightened. Cracks appeared. Banks failed again. Bond markets shook. Governments felt pressure. Same tools. Different problem. Because intervention doesn't remove trade-offs. It relocates them. This is why financial systems depend on these tools. Not because they're broken, but because they're human. Built on trust. Fueled by confidence. Vulnerable to panic. No amount of math removes psychology. No regulation eliminates fear. No model predicts mass behavior under stress. So intervention exists as a circuit breaker. A pause button. A reminder that the system isn't natural law. It's engineered. And engineering requires maintenance. The bigger question isn't whether intervention will happen again. It will. The question is whether the tools still work at the scale required. Because each use reduces future flexibility. Debt levels rise. Political constraints tighten. Public trust erodes. And at some point, intervention itself becomes contested. That's the real risk. Not inflation. Not recession. Not even crisis. But disbelief. If markets stop believing intervention can stabilize outcomes. If citizens stop believing rescues are fair. If governments lose the ability to act quickly. Then the system doesn't just wobble. It rewrites itself. Quietly. Painfully. Unevenly. So here's the unresolved thought. If modern finance can't survive without intervention, and intervention reshapes the system every time it's used, are we stabilizing the future? Or slowly trading it away for one more day of calm?